Good morning, everyone. Welcome to today's webinar on insurance procurement for FE colleges. My name is Agnieszka Gaili, and I'm the category buyer at YPO. With me, I have Phil Webster, who's the executive director at R2J Gallagher's education practice. Before we get started, I would like to go over a few items so you know how to participate in today's event. You have all joined this webinar in a listening mode only. You will have the opportunity to submit text questions at any time during the presentation simply by using the question pane of the control panel. We will try to answer all the questions at the end, but I will create a Q&A document and share it with everyone after the end of the webinar. Just so you know as well, this webinar will be recorded and sent to you in a follow-up email, so you can view it again or share it with your colleagues. So today's agenda. We're going to cover the financial environment for FE colleges, focusing on the impact of the local area review. We will go through insurer participation, how the market changed, how it's developed, and what trends we've observed. Some insurance market update around latest on the Ogden table and insurance premium tax. Phil will go through some covered developments, the ones which are very specific for FE colleges. You will be provided with some guidance and tips on how to plan your tender and how to structure your tender to get the best outcome possible, and what are the procurement options available to you when you approach an insurance market. And we will finish today's webinar with why do you actually need an independent advice from a broker. Right, so I will hand over now to Phil, who will talk us through the recent changes to the FE colleges landscape and what you need to be aware of.
Good morning, everyone. Thank you, Agnieszka, and thank you for taking the time to join this seminar. Whilst the perception may be that we're brave in putting together what are admittedly not the most invigorating of subjects, procurement and insurance, we do believe that the outputs from this will hopefully be informative and lead to colleges having in place more cost-effective and appropriate coverage for their key assets, their students, their staff, their buildings and their surroundings. So as Agnieszka has outlined, we're going to be looking at a few areas relating to the financial environment for FE colleges, and then insurer participation in the insurance market, cover developments, and then also planning your tender. Just to echo what Agnieszka said, there's a good opportunity to ask some questions at the end of this. Please do take this and fire any questions that you have. If we can't answer any questions immediately, we'll go away and seek out the answer and come back to you. So just kicking off in terms of the financial environment for FE colleges, having worked in this sector for a number of years, we know that there's been some substantial changes. We know that the government's stated aim in reviewing post-16 education and training institutions through the 37 area reviews is of creating strong and financially resilient colleges with an emphasis on working together. We know that this began in September 15, with the last wave concluding in early 2017. The reality of the output, as you can see on the screen, is that actually what we're seeing is from the output consolidation and a focus on economies of scale, and particularly from procurement of supplies and professional services. The quotation there, I think, sums that up, and I think that being realistic now, the output that we are seeing from some of our college clients and other colleges that we're talking to is that this consolidation will mean colleges coming together, colleges working together around some of these procurement items. So what's the impact on that for us as insurance brokers, and the impact on colleges in terms of their insurance program? We'll talk a little bit about that in terms of the insurer participation now. That's a quotation just emphasising the output in terms of the financial environment for FE colleges, and there is a question mark there in terms of what the opportunities are as well. From an insurer perspective, there is probably larger risks. So for them, there is some benefit there around economies of scale, and bringing together multiple sides also gives us an opportunity to review how insurance is both structured and also procured. And I'll go into that in a little bit more detail when we look at some of the covered developments. So what we have seen over the last few years is a fairly significant change in what we call insurer participation in the FE college sector. And there's been a number of drivers for that. Firstly, if anybody is involved in commercial, in the commercial world, they will know that from an insurance perspective, we have been in what is known as a soft market. So that has meant that rates have been competitive and rates have been reducing over a period of time. So insurers participating in the commercial market have had to operate in an extremely soft market. This has meant that securing new business, which is one of the insurers' key sort of markers and one of their key factors, has been difficult. As rates have been low, and in the main, clients are satisfied with their existing providers. The consequence of that is that insurers have been seeking new markets in which to use the capital which is at their disposal. So we have seen insurers coming into the education sector from the commercial sector who haven't traditionally been involved in that. The second factor is the segmentation of the insurance sector, and I think this is one of the key areas. And it means that that insurers are looking at different types of risks within the education sector. There has been an increase in the number of schools which are buying commercial insurance, and that the main driver on that has been academy trust schools, which were previously insured through local education authorities, have come away from those and have been required to purchase commercial insurance. And so what we're getting now is some clear definitions between types of education establishments, so between schools, colleges and universities, and you'll find different insurer participants for each of those, because each brings different aspects of risk. Schools bring very sort of clear risk, because schools can be any ages from 3 and 4 up to 16. FE colleges are fairly more clearly defined in 16 plus, and universities present different risks in terms of the activities that they undertake. So universities are doing some wild and crazy things around clinical trials and investigations and research. FE colleges are a little bit more less risky, and again you're going to get different insurers participating in that. So the view there is that they are clearly different and represent alternative risk propositions, and as such the appetite varies, and now this is understood more clearly by insurers. What we're also seeing is improvements in risk control measures. As in the commercial sector, there have been improvements here. More pertinently, the risk control around liability risks in respect of aspects such as safeguarding, DBS, improved documentation are tighter, and therefore the chances of successfully demonstrating a breach of duty of care are reduced. I think as well what you're also seeing is improvements in just physical assets, so improvements in fire and security controls within buildings, as sort of things like fire risk assessments and fire precautions are implemented. Evidence of this, I think, is probably seen in the increased participation on some of the sector frameworks that we'll discuss in the future, such as CCS, which is now 26 participating insurers. And whilst not all of those will respond to a tender, there are some niche insurers, and again we'll come on to that in due course. So the last point is around those specialist insurers. We will go into that in a bit more detail later in the webinar. So unfortunately it's not all good news, because there are also some factors which are increasing premiums, and I just wanted to touch upon these just so buyers are aware of what the issues are there. What I wanted to touch upon are some of the factors which may be used as rationale for premium increases. The key one here is a development that we've seen only this year, and that's the second point on the graph here. The first point is relatively self-explanatory, and as we've seen through the election, there are issues facing everybody around rising care costs and longer life expectancy, which has an impact on insurance premiums in terms of life insurance, and that has a knock-on effect in terms of commercial insurance. But the key factor I wanted to touch upon is the Ogden table and what's known as the discount rate. This is a really important area and has been a big development in insurance in 2017. For those of you who aren't aware, the Justice Department recently announced a change in the discount rate. Now, the discount rate is the calculation which is used to assess the net rate of return for investment by any claimant on any large personal injury claim and the lump sum and payment which is provided through that. The current rate of 2.5% will reduce to minus 0.75%. That rate was the amount, the 2.5% was the amount that insurers could deduct from any lump sum payment because of the return that a claimant would claim or achieve through investment of that lump sum. Now, because investment returns, the Department of Justice view, have reduced, that means that discount cannot no longer be applied, and in fact it's gone into a negative. So actually insurers need to increase their lump sum payments because the investment returns won't be there. The impact is that large personal injury claim costs will increase if this goes through. We believe it is being reviewed, and when the Department of Justice announced it, the following day there was some fairly strong representation from the insurance industry to the Chancellor of the Exchequer, expressing concern that this is going to have a significant impact on everybody's premiums. So the car insurance that you buy, any sort of personal insurances that you buy. So it's not only relating to commercial insurance, but commercial insurance clearly is going to feel the pain the most, because that's where you see the large personal injury claims. The further impact on this is that indemnity limits may need to increase. This is because the potential single amount an individual could claim could increase. The previous largest personal injury award in the UK was circa £23.5 million. So it just shows that if you've got indemnity limits under your public liability policy of 10, 15, 20 or even 25 million, those may be inadequate in the future. So claims in the other impact is that claims in the pipeline may be stalled as solicitors wait for the new calculations to kick in. So if there's any liability claims ongoing, these could be parked or put to one side for the time being to ensure higher payouts for clients in the future. So the other impact just to be aware of is insurance premium tax. Again, there's nothing we can do about that particularly. The government seems to be set on the insurance industry being tax collectors, and this is a significant stealth tax system. Anyone who purchases insurance, again from car and house insurance through to businesses, charities and educational providers. So in June this increases to 12%. That's the third increase in the last 18 months. But unfortunately, I don't want to be sort of doomsayer, but we might want to watch this space as further increases may be made. Some European countries have the insurance premium tax as high as 20%. So again, watch this space. But it's just, again, it's going to see an increase in your insurance premiums from last year, just because the rate has increased. Again, nothing brokers or insurers can do about that. The last point is just tying in with the Ogden table aspect. in the insurers' investment returns have reduced, and therefore premiums we anticipate could increase as a consequence of that. So what I want to do now is just spend a little bit of time on some cover developments. And there have been some significant developments here that I want to go into in a bit more depth. As insurers and underwriters have sort of hit the wall, if you like, on the ability to outprice each other in the soft market conditions that I spoke about, they have turned to other aspects on which they will be judged. And that's beneficial, we think, to colleges, because it includes cover, and whilst there's an element of tightening up interpretations of claims, with insurers relying more and more on the actual policy contract, it's our belief and evidenced in our recent exercises that they are granting more specific and appropriate coverage. A good example is a college in Yorkshire with whom we worked last year. They had experienced a major property loss, which also involved their business interruption loss of profits cover. Now, due to the specific nature of funding for FE colleges and associated lagged funding for certain students, the impact of the disruption in the first year was not actually felt financially until years 3 and 4. The structure of the business interruption cover, which is standard for the majority of commercial cases, was to limit the indemnity period, i.e. the time amount during which cover would respond, to 36 months. So you can see what the impact is there. If the cover ceases after 36 months, it means that the financial impact felt in years 3, 4 and 5 wouldn't technically be covered. So what we've actually been able to do there is to negotiate a specific deductible for that element to reflect the delay in impact on funding accordingly. And that was something which insurers were happy to support. So again, a consideration both when you're selecting your broker and then when also you're selecting the insurer that's going to provide the cover for you. So a couple of other points I wanted to touch upon. Cyber liability data breaches. Again, this has been in the news a lot in the last month, with thoughts turning to the NHS incident with downtime there. I think we all accept that all of us are increasingly reliant upon IT systems. And then also, the second point, the data breaches, the regulatory processes around data and its security have advanced significantly. The ICO, the Information Commissioning Officer, are taking a closer look at organisations. The regulatory environment is tightening. There's further legislation coming out next year relating to data protection, and breaches of that are subject to fairly significant fines now. So again, it's a consideration because we know that colleges hold a lot of data on their students and sometimes a lot of sensitive data around health, safeguarding, etc. And it's important that that data is looked after carefully. Also, I think it's important to not just focus on IT systems, but also understand that this relates to paper records. And whilst a lot of us are trying to move towards paperless systems, that's not always possible. There was a fairly significant fine last year for a local authority in the south of England where there was an abandoned warehouse which they no longer occupied, and they'd left some filing cabinets with paper records in. Somebody found those, it was reported, and there was a fairly significant fine against them. So again, it's just understanding how you're storing both paper and digital records. So some considerations there around cyber liability. We do accept as insurance brokers it hasn't been the most accessible of insurance cover, and we're trying to make that more accessible, and I think insurers are trying to make it more relevant for education establishments. It was principally bought by financial institutions, but I think we're moving away from that as we recognise that organisations are more reliant upon their IT systems. The downtime can significantly impact them, and the data breaches are something to be aware of. Lastly, I just want to touch upon something which has obviously been in the news a lot recently, and the threat of terrorism is clearly present in all of our minds at the moment. From our perspective, crisis resilience and terrorism solutions have developed in response to the changing needs of our education clients, and particularly in relation to security risks. I think, if we're being honest, recent terror activities that we've seen have more impact in terms of financial loss, reputational damage and disruption to activities rather than actual physical damage. And I think that's really important, because the terrorism risk has changed from large explosive devices to what we call sort of lone shooter or marauder activity. And that has an impact on you, but it may not have an actual impact on your physical premises. So again, it's important to be up to date in terms of what your terrorism insurance, how it responds, what the triggers are, because the historic triggers are an actual physical loss. And as we've seen, whilst there may be some physical damage, actually the impact on your organisation may not be that. So it's important that you understand what the terrorism insurance solutions look like and what the response to those is, and whether you've actually got support, for example, things around contingency, trauma counselling for your students, etc. So that's just what I wanted to cover off in terms of the cover developments. Again, any questions on those, we would be happy to take. So what I wanted to do next is just talk about the building blocks of a successful tender from our perspective. So we're just going to go through each of these items. The first one is the claims data. This is really important. It's really important, we think, that you get your claims data into an understandable and clear format. And the reason for that is that as brokers, we recognise that insurers will reserve claims, and that's important that they accurately reserve. But I think as well it's important that any reserves are challenged by your broker. And the reason for that is insurers will sometimes use large reserves to justify increases or even to resist reductions. So it's really important that you get your claims data into an accurate and up-to-date format. So any new insurers get a really accurate and clear understanding of what the position is on historic claims. I think as well, any large claims, we would always recommend that you get a bit of a narrative and a bit of a story behind those to explain both how it occurred and then any subsequent action that you've taken to remove or mitigate the chance of that claim occurring again. Your property data, again, really important that this is accurate. Insurers will make judgments based on the quality of your fire and security protections. If they don't know, they will assume the worst, because underwriters are cautious people. So it's, there is a vast difference between a bells-only alarm system and one which has central station monitoring. And a good broker will spend time with you gathering this information and making this clear. If you're going to invest in improvements, we would recommend that you include the details and costings in your market presentation and ask insurers to rate accordingly, because you can then understand the cost-benefit analysis of implementing that improvement, and sometimes also maybe even get a financial contribution from your insurers for that. Also, your sums insured are important that these are accurate to avoid application of average on any property damage or business interruption losses, which would see the final settlement reduced. So again, if you haven't done this for a number of years, we would recommend you get a valuation of your property. Financial data, again, that's important that it's up to date, because that's what insurers will be using to put their rates against. You will get an opportunity at the end of the year to adjust that, so to make final declarations. But again, let's try and get that as accurate as possible. A timetable and a process, we think this is really important, and we probably should have put it first, to be honest. But it is really important that you plan in advance and that you're clear and that you allow time for underwriters to ask questions. It's good for them to allow them to rate competitively, and they can only do that if they're able to really understand your risk and ask questions. There's also a requirement under the new Insurance Act 2015 and your duty of fair presentation that you allow time for insurers to ask questions and for you to give the answers. Lastly, business interruption. I think this is really important in terms of the tender structure, because as we've already outlined, there are nuances for FE colleges and their funding, and that needs to be really understood, because it could cost you thousands if it's not done properly. So we would usually recommend that as part of any insurance tender process that you just review your business interruption cover. Is that accurate? And when was the last time that was changed? Does it really reflect where you are at? And particularly with these local area reviews, you know, does your business interruption need to accommodate for all of your sites? Or if you lost one site, would you be able to move students around? So again, we recommend that you tie your business interruption review into business continuity planning. So that's where we are in terms of the tender process. What we're going to do now is just look at a few of the ways in terms of how you actually engage with the insurance market. So we've outlined sort of 3 principal routes, and Agnieszka will then go into one of these in a bit more detail. As we outlined earlier, much of the output from the local area review has its focus on economies of scale and achieving best value on supply of services. Now, formal procurement for FE colleges probably cannot be avoided, particularly if a college wishes to take a financial advantage of a long-term agreement, which would mean that the contracts are across multiple years and therefore probably in excess of the overdue thresholds. Our view is, if done poorly, procurement can be time-consuming and will have a negative impact on your desired outcomes of improved pricing and cover. And so my principal recommendation here is to take time to consider the various procurement options available. And for sake of clarity, I'll spend a little bit of time on these options, and then Agnieszka will go into a bit more detail on one of these. You can do a full overdue. There are a number of specific procedures, but unless the college has access to a really strong and experienced procurement individual or team, we would usually say that this is entered into with caution. A proper overdue tender is a lengthy process and requires full, transparent criteria and subsequent evaluation. Most FE colleges that we speak to will probably want to access the various frameworks that are available. Now, the 2 principal frameworks are firstly the CPC. Now, this is the Crescent Purchasing Consortium. This has been in situ for a number of years and has been reconstituted on a regular basis to reflect changes in the makeup of participants. As a multi-supplier framework, each college submission is part of a mini competition between participants. Each college completes a risk questionnaire requesting the cover that they require. And when the bids are received, the college evaluate these and determine the winning bid. There is support available for both completion of the questionnaire and evaluation of the bids for a fee. In 2017, we understand CPC was reconstituted to provide for 4 principal participants. The key selling point on CPC is that it demonstrates compliance with procurement regulations. The second route is CCS, formerly known as GPS. The framework is supported by central government and allows users to appoint a broker from a pre-approved list. I'm now going to pass over to Agnieszka, who can expand on this.
Thank you, Phil. I will just go through the main points of the Insurance Services Framework Agreement. It has been established in partnership between 4 buying organizations, CCS, YPO, ESPO, and NIPO. It's open to any public sector body within the UK. It's not specific for FE colleges, but anyone from public sector can access the framework. It does cover a comprehensive list of insurance risks, and it does cover a comprehensive list of brokerage, core, and support services. The relevant lots for you are Lot 1, Insurance and Support Services, when we've got 26 insurers appointed to that lot. Majority of those insurers are broker markets only, which means they require a broker to approach them in order to provide a quote. Some of them are managing general agents, and we do have direct insurers as well. Lot 2 is for insurance brokerage and support services, and on that lot we've got 12 brokers appointed. Well, I'm just going to go through why is this framework really supported by insurers and brokers. Firstly, because the tender fatigue is eliminated and it saves time and resources. The comment I received from insurance industry says that participation in a tender is costly in terms of price and resources. Insurers don't like spending time answering selection criteria, PQQs, answering questions about environmental policy, health and safety policy. They like to focus on underwriting of the risk rather than on paperwork. And you might be surprised, but during a tender exercise, much bigger effort is on insurers who, in a very, very short time, need to provide you with the right cover that will pay for the claims in 6-10 years time or more. Another important point is that the framework provides a simple route to market. It allows you to enter into long-term agreements, could be up to 5 or 6 years. And one important thing is that only one chosen broker approaches insurance market. This removes uncertainty of which insurer responds to which broker, and what's more important, separates broker from insurer. In this situation, broker is acting on behalf of a customer, provides independent advice, and evaluates all the proposed bids from insurers. This is just quickly to go through the CCS Insurance Services framework process. So technically, college uses the framework agreement in 2 ways. The first step should be to appoint a broker through lot 2. Customers got 2 choices. They can use either direct award. The pricing has been established. Comprehensive specification is available to customers to view. We ensure that the terms and conditions are fit for purpose. Or the customer can run a further competition to test and benchmark brokers appointed on the framework. Once broker is chosen, the broker will work with you to understand your risk, understand your requirement, to put market presentation together, just help you engage with your organization beyond the known risk. And that one chosen insurer will go to lot 1, to those 26 insurers, to actually do the capable insurers and receive quotes from them. The broker as well, the main point on the insurance services framework is that the broker will evaluate all responses received from the insurance market and will prepare recommendations for you. And then it's up to you then to decide which cover is the best for you. The main benefits of the framework are it's a quick and easy access to brokerage services through direct award. And the main point is around the independent role of a broker. Comprehensive broker specification and pricing is available for you to use. Like I said before, we established the terms and conditions of the brokerage services. You do have facility to test markets and benchmark all the providers. The time and resources are saved for not only for you, but for brokers and insurers as well. The due diligence has been completed, so all the providers went through a selection process. So by accessing the framework agreement, you're actually using a compliant route to market. And we do, on the framework agreement, we do have a really good spread of insurance markets. So broker is your gateway to the insurance market. He's your full-time specialist with professional skills in handling insurance business. So when it comes to brokerage services, obviously you need to incur some costs, but what you need to focus on is what you're actually getting for the money spent on the brokerage services. Choosing a broker with the right skill, knowledge, and market relationship is vital to the successes of your procurement strategy. And with this in mind, I will hand over to Phil now, who will who will explain now what you should consider when appointing a broker.
Thanks, Agnieszka. I think it's a really good question. Why use a broker? And we recognise that this is a valid question. And we recognise as well that consumers receive a fairly regular media message questioning the value of middlemen, asking what it is that they're adding to the process. I think key to reviewing this question is understanding that an insurance policy is a legal and binding contract. It is based on providing accurate information reflecting the duty of fair presentation that I mentioned earlier. And as such, negotiating and entering into a contract, we think, requires professional support, in the same way as you would seek out a solicitor if you were entering into any other legal contract for independent professional advice. We also recognise that there is a tranche of direct insurers who represent a portion of the market share. Compliance and regulation of the insurance industry means that direct insurers can only really comment on their own contract, and that they're unable to offer advice or recommend cover outside of that. So the need for independent advice means that a fair number of insurers will only transact business through a broker. It's also because they don't have the infrastructure in place to manage the day-to-day support for policyholders. So in terms of what areas we would recommend you look for when you're appointing a broker and when you go through Lot 2, we've highlighted 5 areas. And again, whilst there is guidance on the framework, you're pretty much at liberty to set the criteria as you want. So these are the things that we think you should consider. Firstly, experience. Does the broker have the ability to guide you through the procurement required and reduce the risk of non-compliant processes? How involved in the education sector are they, and how conversant with the risk insurance issues are they? Secondly, the market authority. Does the broker have the presence in the market to deliver meaningful results? Are they able to articulate your risk profile to prospective insurers? And will they be able to create a positive risk profile for your procurement? These are all really important areas when you're considering a broker and what responses they're going to get when your market presentation goes out to the insurers. Thirdly, I think this is really important, the account management and support. And through the broker process, you should be identifying what account management support your broker will commit to. Will services be provided locally or from a dedicated centre? And what's really important for you here? Is it important that they're local, or is it important that they understand the education sector, or is it a combination of those factors? Value for money, that's clearly important. Do the fees submitted in the process represent value for money? If very competitive bids are submitted here, is the service compromised, or are earnings being properly disclosed? And lastly, the added value aspect. What additional support is your broker offering? What aspects of their additional service will your college genuinely benefit from? Sometimes brokers will put things in there which look good, but actually, what benefit am I going to get from those? And within, the procurement process, you're completely at liberty to ask those questions and put the brokers under a bit of scrutiny in terms of, these added value things. Do they actually help me? How will my college benefit by putting that into place? So I think we're going to conclude now in terms of what your goal should be. And there's 3 takeaways that we wanted to identify here. Firstly, the appetite for risk. And I think this is important based on what we've said about your risk profile. And what we're trying to do here is link your insurance and risk management program to the college's overall objectives and its KPIs. And we think it's only by doing this that you can make judgments on the success or otherwise of the insurance program. Secondly, manage the risks you carry. Our position is that with good independent advice, buyers will make an informed decision as to what risk that they have and what is the best way to manage that. Management of risk includes your insurance procurement, but it needs to be combined and linked with your other internal strategies, policies and procedures. And again, that needs communicating. And lastly, coming back to that point about your organisation's objectives. Sometimes insurance and the procurement of insurance is kept in a bubble and away from everything else that your college is trying to do. what we recommend you try and do is link the insurance procurement and purchase to your wider financial and strategic objectives. And it's only by doing that that you'll get financial support for initiatives, and you'll actually be able to measure it. So it's not just kept in a bubble, and it's not just an insurance renewal that you have to do once a year, and there's a bit of pain involved, and no one actually really benefits. If you link it to your organisation's objectives, we think it's, you're going to see a lot more value from the process, and you'll be able to demonstrate some really good procurement.
Thank you, Phil. We are going to take a look at a couple of questions from today. The first question is from Chris, and the question is it better to split the program into lots or ask for a whole package?
It's a good question. I think, I mean, one of the benefits of the CCS framework is that you are allowed to split it down into lots, and you are allowed different insurers to respond to different aspects. And as I said earlier, one of the features that we've seen in the insurance market in the last few years is the entry of niche insurers. So these insurers will want to write, for example, the personal accident and travel for the students, the motor insurance for the college, maybe the trustees indemnity, but it's only those particular classes of insurance that they're interested in. Now, we encourage that because we see that their premiums are competitive and their cover is broader than has been available historically. But those insurers don't want to write the buildings and contents liability insurance, the liability insurance, or maybe other classes. And so by breaking it down into lots, we can encourage the participation of those niche insurers. Now, you know, outside of the education practice, Gallagher have commercial clients. Not one of those commercial clients would have one insurer across all of their different policies. It would be too much of a coincidence that you've got one insurer that's the best at everything. And so by doing lots, you're able to pick and choose and build what we call a best of breed program.
Thank you, Phil. The second question is from Paul, and the question is, if we use a broker to conduct for the competition, but then direct insurer wins the business, will I still need that broker?
Yeah, I mean, that's a good question. I think, you know, we do have some direct insurers and we encourage participation with those direct insurers. The question really comes back to what does the client want? Does the client just want the broker to carry out a procurement exercise, or do they want advice and account management support going forward? Because we have seen examples of direct insurers where they can't actually do everything. So there may be, for example, things around large construction projects or terrorism policies or fine art, for example, where that direct insurer just can't do it, and therefore the college is needed to access a broker for placement of those policies. I said it just comes back to what the college wants, and you know, often the direct insurers, there's a sort of tripartite relationship there, where the college can engage both the broker and the direct insurer, and that's not unusual. So it really comes down to what the college wants at the end of the day.
Thank you, Phil. The final question is from Anna, and the question is, would you recommend to take out long-term agreement?
Yeah, some good questions here today. Long-term agreements, I think, in the past have provided financial discounts. As a broker, I think it's important that I make clients aware that long-term agreements are principally written for insurers' benefit, because if it's a good risk and they haven't had claims, then the client is obliged to renew with the insurer. But if there's something which the insurer doesn't like about it, then they can increase the rates and they can walk away from that particular risk. So it does give some budgetary certainty. What we would usually recommend is that there's some quid pro quo with a long-term agreement. What is it that the client's getting from it? Okay, it's getting some budgetary certainty, but not absolute budgetary certainty. So why don't you build into that some sort of low claims rebate? So if the insurer has got a good clean risk in there and they're underwriting the risk at a profit, why don't we see some return on that based on the claims performance? That encourages the client to focus upon risk management as well, and it encourages the insurer to participate in the risk as well.
Thank you, Phil. Right, like I said at the beginning of this webinar, I will create Q&A document and share it with you in due course. I just would like to say a big thank you to Phil, who has kindly shared with us the latest changes in the market and how they're going to affect you, and provided us with valuable guidance on insurance procurement. On behalf of YPO, I would like to say thank you for joining us today. I hope you find this session useful. You can always contact directly myself or Phil if you've got more questions. And just have a great rest of the day. Thank you.
Thank you.